Hey everyone, welcome to this explainer. Okay, so how can a struggling business's financial losses actually be transformed into incredibly valuable future tax assets? I know taxation mechanics usually sound super dry, but stick with me here, because understanding loss relief is honestly one of the most powerful tools you can have for business survival and recovery.
Seeing that red ink on your ledger? Yeah, it's a super painful reality for a lot of entrepreneurs. It's literally the exact opposite of what you set out to achieve. But today, we're going to explore how the tax system doesn't just punish you when you're down. In fact, it actually offers a vital lifeline to recovering businesses. If you know the rules, your current financial pain can literally be banked to protect your future success.
Here's our roadmap for today. First, we'll look at the silver lining of losses. Then the 2 types of relief, the 6 rules of loss relief, a quick case study on POSU Limited, and wrap up with why loss relief really matters.
All right, let's jump right into Section 1, the silver lining of losses.
So before we can even begin to claim relief, we kind of need to recognize what a loss actually is from a legal standpoint. Legally speaking, a company makes a loss from its trade or business simply when its allowable operating expenses are higher than its total income or earnings. It's really that simple. More money went out for allowable expenses than actually came in.
Now here's the absolutely crucial point. A company that makes this kind of recognized tax loss is actually entitled to relieve it. You don't just lose that money, say, oh well, and move on. No way. You can carry that loss forward to set it off against assessable profits in subsequent years. Think of it like earning a legally binding discount coupon that you can apply to your future tax bills starting from the year right after the loss.
Moving right along to Section 2, 2 types of relief.
So there's a pretty stark contrast between your 2 options here. On the one hand, we've got current year loss relief. Now this one is restricted entirely to individuals, and just a quick aside, it's not available for property letting businesses either. If you go this route, you've got to make a written claim within 12 months. But the massive benefit here? Losses from one source can actually offset income from totally different sources. On the flip side, we have carry-forward loss relief. This one works for both individuals and corporate bodies. The cool thing is, you don't even need approval before this relief is granted. However, the trade-off is that it's only available against profit from the exact same source of income where the loss originally happened. Okay, let's get into Section 3, the 6 rules of loss relief. Now, there is a pretty strict framework for compliance here. First off, your trading loss deducted from assessable profits can never, under any circumstance, exceed the actual loss you incurred. Makes sense, right? Second, chronological priority really matters. If you have losses from 2 different years, the first loss incurred is relieved in priority to the subsequent loss. It's basically a first-in, first-out system. Third, if a trade ceases entirely, any remaining terminal loss that couldn't be relieved is just deemed lost. And finally, under the Nigerian tax system we're looking at here, there is absolutely no provision permitted for carrying back a terminal loss to previous years.
What's actually really fascinating about this is the strict same source rule, derived from Section 31, subsection 1 of the Companies Income Tax Act, or CETA for short. Losses are not just dumped into some giant pool with your assessable profits. A trading loss from one of a company's sources of profits cannot be set off against profits from another source, period. So if you take a hit in one specific line of business, it can only be relieved in future years from assessable profits derived from that exact same source.
And hey, before we look at the math, you absolutely must remember this golden rule. Relieving your losses will always take precedence over any claims for capital allowances. If you happen to have both, the tax system demands that the loss relief happens first, no exceptions.
Let's see this in action with Section 4, a case study on POSU Limited.
Consider the real-world story of POSU Nigeria Limited. This company went through a really rough patch, years of consecutive compounding losses. We're talking a 350,000 naira loss in 2012, 250,000 in 2013, and a massive 457,000 in 2014. But you know what? They didn't fold. They kept at it, made a strong recovery, and eventually turned a 450,000 naira profit in 2017.
And because POSU Limited actually understood these tax rules, they were totally prepared for that 2017 recovery. Let's look at the numbers. In assessment year 2013, their $350,000 loss from the prior year was carried forward, along with $25,000 in capital allowances. That created $375,000 in unrelieved offsets. Skip ahead to assessment year 2015, they took that new $457,000 loss, added it to the previously unrelieved losses, and combined it with their capital allowances.
By meticulously carrying forward their losses and adding their capital allowances year after year, they accrued over 1.1 million naira in future tax offsets. It's incredible. They essentially built this massive shield to protect their eventual 2017 recovery from heavy taxation.
Which brings us perfectly to our final part, Section 5, Why Loss Relief Matters.
At the end of the day, it really all comes down to three massive advantages. First, it directly reduces the amount of your assessable profit in future years. Second, as a direct result of that, it significantly reduces the total tax payable by you, the taxpayer. And third, it provides an incredible opportunity for enhanced cash flow. Correctly applying these rules literally prevents businesses from overpaying taxes during their most vulnerable recovery years. It rescues your cash flow precisely when you need it the absolute most to rebuild and stabilize your operations.
So I'm going to leave you with this thought to end our explainer today. Are you structuring your business to ensure your current losses become tomorrow's tax savings? Seriously, take a close look at your own operations, your bookkeeping, and your overall financial strategy. Make absolutely sure you aren't just leaving your hard-earned future tax assets sitting on the table. A loss today doesn't have to just be a loss, it can actually be the very foundation of your future profitability. Thanks so much for joining me on this deep dive, and keep learning.